Okay, folks, welcome back. This is our midweek review for the ICT Mentorship for April 29th, 2020. All right, so here is our Dixie or dollar index daily chart. And you can see here we have a few things annotated. These are the things that I want you to focus on for right now. And the red eyeball is basically where I'm focusing my attention. So therefore, as students here, your attention should be focused there as well. That is a sell-side liquidity pool. Otherwise, I would have just the abbreviation for sell-side liquidity there, much in the same way I have buy-side liquidity up there. Just a easy, quick little abbreviation. And then here's your BISI, buy-side imbalance, sell-side inefficiency. Longer term, intermediate term, this is where I think we're going to go. Maybe consequent encroachment, about 97 big figure. Tomorrow on the economic calendar, you'll notice that we have the unemployment numbers expected at New York Open. I'm expecting some lower descent on price going into that, and then once the number hits the market, we should trade below this low. I don't think it's going to be good. Nothing's positive about the numbers in terms of jobs. It should be a heavy weight on the dollar index and try to make an attempt to get below here. Any acceleration below that takes us into the sell-side liquidity pool resting in here, and then what we see in regards to that, if it materializes, because I'm going to give you the thing in a moment that would negate this, but this is where I'm siding on the marketplace. In other words, when we're watching the reviews, I may give you the other side that would constitute me being wrong and what I would anticipate seeing as a catalyst for me being wrong. And the reason why I do this is for your notes. It's not because I want to have a plan B so I can come back next time and say I was right about this. Notice we don't do that here. I don't do that. There's a lot of illumination, if you will, when you watch other people pretend to be mentors or teachers and they show you a plan A and a plan B. And if you just watch them long enough, they'll always come back and say, yeah, I was right about that one. Okay, we'll trade that. Okay, trade it. Well, the thing with me giving you the elements that would negate my underlying bias, okay, would also constitute the groundwork and framework to maybe, not always, but maybe build a reversal model. So in other words, if I was expecting bearish dollar, like I'm expecting tomorrow, the swing low in here, if it doesn't find its way in terms of being rated, and we have the bullish order block right in here, okay, right in here, this candle, let me put a little line on it so that you can see. When we drop in lower time frames, it'll be more salient. All right, so if we darken it up, I'm going to put a little bit of a blue on it. That way it'll be different. All right, so we do not want to see it dive into this and stop right there and rally. We don't want to see that. We want to see it just eat right into all of this candle and do so with very, very little difficulty. In other words, a great deal of ease. We want to see dollar drift right on into this candle. The time it takes to get through that, okay, as long as it's ahead of the unemployment number tomorrow at New York for the US, that's fine. But we do not want to see it hovering above the order block and then dig into it a little bit during the unemployment numbers and then see any kind of a bounce that way. Because then what that would do is take us up to the buy side liquidity and back into contention for the volume imbalance that resides between this candle's close and this candle's open. Okay, so I don't want to have it on the chart, get too many things to be focusing on. But we're expecting, or I'm expecting, I mean, cosine, it's not you doing it, it's me. I'm saying that I think the dollar should be heavy and trade down into this level here. And then depending upon, what type of number we get in the reaction, we may be in contention for this run on this low here, maybe as early as Friday. Okay, so we'll see what we get in regards to the economic calendar and the events outlined just a moment ago. Let's go into the hourly chart. Okay, so here's our dollar index 60-minute chart, or 1 hour. You can see we had a really nice setup here on the 28th, punched above this high here, ran buy side liquidity, dove lower, clearing up all the sell side liquidity resting below these equal lows. We swept through that, came back up to consequent encroachment between the open of this candle and the high of this candle, split that in half, It's about right in here. Just fell short of that. Runs buy side liquidity, and then right now we have the sell side liquidity resting below this low here in very easy targeting. SIBI, sell side imbalance, buy side inefficiency, runs up into that. Displacement. Okay, so we have displacement here, a willingness to want to go lower, retracement, lower, starts to bounce. What's it leaving? Relative equal lows. And it should dive down into, again, we want to see it go into that 99 big figure, deeper than just 99.38. We want to see it go into 98s and just have no problem whatsoever trading lower. 15-minute time frame on the dollar index. All right, so you can see it just looks heavy. You know, this is one of those times where maybe you can see a bear flag. I don't like to do that too much because this is one of those instances where it looks like a bear flag, but it's not, and it comes back up and runs it. So I already know some of you are going to ask, well, what makes it a valid bull flag, and when can we trade against it? There's actually lessons in the core content that talks about that. Bull flags, I talk about phantom trend lines and things like that, where it looks like it's there, you get fooled by randomness, and then you can actually take the other side of the marketplace and do what would otherwise be very scary as a retail trader, because they look at this and say, oh, this is a bear flag, obviously. Well, what about this one? Wasn't this one a bear flag? Not if you understand the context of what was going on. And I'll talk a little bit about the idea I tweeted, I think it was yesterday. Yeah, it was yesterday, saying that if you, right now it's tight ranges on the daily chart. So if you use your 4-hour or your 1-hour chart as your daily, and then look at how we trade with the daily chart, my analysis and what we're looking for, how it pans out over a little bit longer time period, which is not my comfortable area of trading. I like to be in here in a shorter time frames because I can get velocity. And I got questions about what I meant by velocity. Velocity is where you take your account and you turn it over and over and over again with high frequency trading, but you have to have a solid understanding of what you're doing. If you can't be consistent with any other time frame, you know, it's not that the lower time frames are secret sauce. Okay, they're not the panacea to the riches of the marketplace. It just provides the opportunity, the mechanism, okay, or the conduit to having frequent setups. It's hard to be a high frequency trader with a daily chart, okay, because the time frame is just, it's too slow. It's not moving enough. It's not enough dynamic price action, and it can move a whole lot inside of that one single daily range in respect to what it has done just in the previous day. And I'll talk a little bit about that as our lesson for this week. All right, so anyway, we're looking for heaviness on the dollar index. If we do pop up in here and run this here, and just to get back in the middle of this or right above the high here, if we get into that, that's still, in my opinion, an opportunity to get short on dollar with bias. Not, we don't trade the dollar index, okay, but we would look for longs to really be gearing up on foreign currencies like euro, dollar, and cable. But I'd rather see it just be heavy, remain heavy overnight, and just dig into that 99 big figure and drift into 98s. All right, so let's go back out to a daily chart and roll into euro. I'm trying to keep these videos a little bit more shorter than I have been. I got a couple complaints from some of the members. Hey, man, I got so many hours to go through on these videos, I just can't keep up. I'll say, well, that's convenient because I'm tired today. The last 2 days I've been really taking a lot of executions in cable. You guys have probably been watching that on Instagram. The euro dollar. All right, euro. All right, so here's our daily chart, and this will make more sense when we get down to lower time frames. So we ran that low, okay, and I gave you guys last week the assumption that if I were the market maker for the European Central Bank, and that means I was able to completely control and set the price, just like a store owner would, okay? And it's very hard for some of the new students that come in, they hear this, and it doesn't sit well. It just, the markets can't be that controlled. That's illegal. Well, listen, if you went out and you set up shop and you wanted to start selling women's shoes. Not only would my wife want to go to it and frequent it, but you would have the expectation to draw clients in to buy your shoes. Now, who's in charge of setting the price for those shoes that you're selling? You are. You determine what your wholesale price was, and then what your profit margin is that you're trying to capture per sale, and then you set that price accordingly. Now, whether the public or the consumer that comes into your store that sells these women's shoes is aware or not, if you got a bulk shipment of women's shoes at a really deep discount price, and you have a whole lot of them, but they're seasonal shoes, something that wouldn't otherwise be worn in the coming fall and winter months. For instance, maybe it was a sandal or a woman's flip-flop. That could be a motivation for you to really set the price when you sell those typical shoes at maybe a $25 benchmark for that type of shoe, because you got a very, very deep discount on a stock of them, and it's now simply the first week of June. You have time to unload all that merchandise, but you are the store owner. You can set that price. The public doesn't know that you got that wholesale price at a really, really deep discount, so you can still set that price for that new shipment of seasonal summer shoes for the same price benchmark at $25 that the others are selling for. Or you can say, I need to get these out of my hands because I don't want to carry them through the fall and winter months, and it may be August that you have received them, and you don't have very many weeks left of summer weather, and the impulse for women to buy these types of shoes is going to wane, and they're going to be looking for the more winter fall boot. Okay, and then some of the men here are thinking, man, dude, what are you talking about? We're talking about Eurodollar here. I'm talking about how we interpret price action because of the central bank being the storehouse owner of each one of these currencies. So they are in control of setting the price to whatever they want it to be. And it does not matter. It does not matter what your opinion is. It doesn't matter what my opinion is. It doesn't matter what the economic calendar says. Okay? Economic calendar says this report's coming out and they forecast a bearish number. And it comes out bearish, but the market rallies up. They're going to call that discounting the news. But it's the central bank doing what it always does. It does the repricing. So when I gave the illustration that if I was making the market for Eurodollar, okay, I would take it below this low here to get everybody thinking it was going to go lower, because this would be otherwise a descending triangle. Okay, and they'd stabbed it down there twice, and now we're rallying. I like the idea of a continuous move higher and running out the 109.90, 109.95, getting to 110s. I think that is likely to happen if we get that weaker dollar I was outlining when we were talking about the Dixie. So we'll be looking for that to unfold unless everything just completely unravels, as I indicated for the dollar. If that order block on the daily chart starts to provide support, specifically with the element of time and the volatility injection that would come by way of the economic calendar tomorrow at 8:30 when the unemployment numbers come out for the U.S. Just go back and listen to what I mentioned in the dollar. I don't want to repeat it here, but the point is, if everything is as I outlined and we see weakness on dollar, this should have no problem making an attempt to get up into this high here. Now, I'm not saying it's going to happen, tomorrow or Friday, but we could be above this high, early next week. I'm not really terribly bullish on euro right now. That would change if we get above this high and we close above it. And then we can look back at all the price action it took from this low here to whatever the high forms once it and if. And we're saying a lot because I'm forecasting a little bit in here, but I'm just giving you my bias. You'll see when we go in lower time frames where I'm actually looking at for euro dollar. So let's elongate that a little bit and drop down into an hourly chart. Okay, so here's the hourly euro dollar, and right away your eyes going right there because that's what I want you to see. That is where I think we're going for euro. Okay, so even if it pumps up there into the economic news that comes out for the jobless number for US, it may just go up there, and we have to watch it. Once it gets there, we don't want to see it just go here and then fizzle out and then start to drop down. Not even come back down to like this old high and say, okay, this is resistance, broken support. That's why I don't like that idea. I don't like support and resistance in the classic view of it. My interpretation of support and resistance is based on institutional order flow and PD arrays. Now, that could be viewed as someone that's just coming in or just first time exposed to me saying, I'm renaming support and resistance. I'm not. If you look at all the things on my chart, I'm taking your eye to a very specific level here, because the narrative around that is we have a lot of relative equal highs, and we've already ran those. And I mentioned that we were going to do this likely on the upside, and this is what's remaining here. Okay, so you got to take this and extend it back here and here. All of this in this general area, I think there's a pool of liquidity, buy side liquidity. But if they get up there, I don't think it's going to be just enough to get there and be content with that. I think that they're going to want to stretch price out and get up into this SIBI. Okay, sell side imbalance, buy side inefficiency. All of this in here should get, if not the middle of it, in other words, consequent encouragement, about right here. Okay, that would be enough to warrant an upside target. And from where we are right now and going into London, that could still frame a wonderful opportunity for you to study, even if it's in hindsight. So I'm basically saying this is where I think we're going, and how we trade here after the U.S. Unemployment number hits the market at 8:30 will tell whether we hold that level, or if it just completely rejects and goes lower, then we'd have to consider what is in the market after it ran up to that level. Okay, so in other words, I'm still bullish euro. I'm not terribly bullish going for like 110s right here from Jump Street going into 110s. I'm thinking that we want to just watch it going into here and anticipate that happening at the unemployment number being released at 8:30 tomorrow. Okay, here's 15-minute euro. I like the low here being rated, and then they ran it above these equal highs, and then they took it really, really deep down into this area of order flow. So we have a low here at 108.18, and then the low here 108.17.9. So we had our institutional entry drill right there, and you'll learn about that if you're new. It's in the commentaries. It'll be a very specific lesson that talks about it. There's no rush to get to it. Don't rush. Okay, it's laid out in a timeline that is appropriate for your development. So anyway, we had the price react there and came back down, found some support after running some sell side liquidity, and then they sent it higher. Did not run this low. Okay, now think about how this looks right here. This low with this higher low and this low here. Look at the low here at 108.40, 108.39 rather, and a half. And then we have the low here, 108.39 and 0.4. So it's slightly higher here. Isn't this low, lower low, higher low? Isn't this the exact same price structure that the daily chart showed on Eurodollar? I'm not going to go back to the daily chart, but you rewind the video and then look at how this little area right in here is the same thing that Eurodollar looked like on the daily. And then we're expecting price to go higher. This whole price structure here, low, higher low, higher low, this may be what's unfolding. And like we're saying here, this is a higher high than this high. While it still has the relative equal highs here to still go higher. And again, the levels I mentioned on the daily and 1 hour chart, I want you to think about how this looks very similar to what was shown on the daily chart. The daily chart has yet to show this up movement, but it's the same characteristics on this 15-minute time frame that I'm expecting to see unfold on the daily. It just requires a lot more time, because each individual candle on a daily chart represents a full 24-hour cycle from open to close. This is only 15-minute intervals, so you're going to get a lot more in a short period of time in terms of movement and opportunity to study and see things. But on a daily chart, I'm still expecting the same type of price structure on the daily on the euro, but it's just going to take a little bit of time to unfold. Whereas on the 15-minute time frame, I can do a lot of different setups and trades in this little area right here. This whole business right here, I can do about 6 to 8 different trades, because it is the same idea that I would expect and I outline on our daily charts. And that's what makes price fractal. Fractal is in the sense that if we had a cookie cutter, Okay, laid dough out on a table, and we took a cookie cutter. It was shaped like a star, and you press that into the dough. You pull that piece of dough out, and it's shaped like a star. That same cookie cutter, okay, if we could squish it down into a smaller star and then press it into another section of the dough, we would have a fractal of the very first cookie cutter or piece of dough that we cut into it. And that would be a fractal. It's the same thing, just on a measurable lower grade. In other words, everything that we would see at one size or one dimension or one time frame as it relates to markets can be seen very closely on a lower time frame. Just like a bull flag, okay, I'll talk in real classic price action chart patterns. A bull flag on a 1 minute chart could be seen the very same way on a 15-minute chart, and you'd also see a bull flag on a hourly chart or 4-hour chart, and it may not appear on a daily, it may not appear on the 4-hour, but the fact that that pattern is recognizable, and if you see it on a lower time frame, it still has the likelihood of panning out the same way that that other bull flag did. Okay, so in other words, it's a repeating pattern, but it's scalable on all time frames. So that's why I say it's important for you not to discount the idea of me teaching a lot of intraday things, because it gives me a lot of exercise, and you a lot of exercise, and it gives you experience, because the same things that you would be seeing on a 1 and 5 and 15-minute time frame is the same thing you would be seeing on an hourly, 4-hour, or daily, or a weekly chart if you're a long-term position trader. It's just, how many opportunities can I teach waiting for a weekly or a daily chart to form? It's not a lot. Okay, so the fact that we go into lower time frame charts, even down to the 15-minute time frame, it's important because it really reinforces the idea that even though you may not be looking at trading these lower time frames, and may not have the ability to do so because you're running your business, you're working, or you're in school, or whatever, time just doesn't permit it for you, don't discount it as a study for you, because even if you study it in hindsight, and that's what I was doing back in the 90s when I was running that vending route, I would come home and I would see these things after it happened, and it really solidified the reoccurring formations, and these they just repeat over and over and over again. There might be subtle little differences, but they are very similar to each other in terms of the characteristics and the appearance of them. So that's what fractal is. But anyway, we're looking for higher prices on euro dollar. We don't want to see these lows in here violated. We want to see it run higher. We want to see it continuously run higher and not make an attempt to go lower. Now, why am I saying that? Because we already had a run on stops. It's a shallow run, but it's nonetheless a stop run. We had a stop run here, and we had a stop run here. So it's not required for price to come back down here. In fact, if it went down here, in my mind, and you have this for your notes too, we want to see every time the market moves to run stops below the marketplace, if we're bullish, we want to see it have the ability to easily run higher to new highs. That is another characteristic of institutional order flow. If we have an area where buy stops are run, okay, or they rate above equal highs like we have here, it does that here, but we're not bearish on euro. So when it comes down, it's only coming down to do what? Go back to a discount and run sell side liquidity. And then what does it do after it does that? It runs higher. Creates sell side liquidity here. It drops down. What does it do? It runs higher, clearing buy side liquidity. So overall, what are we looking at? It's not higher high, higher low. What I'm teaching you is the concept of digging into the underlying narrative. They're running buy side liquidity, equal highs here, equal highs here. So this area here and this area here, this ability to run up to a new high relative to previous equal highs and previous equal highs here, and it starts to drop down. That doesn't mean reversal going lower. Okay, it doesn't mean go down here and start looking for this to be a balanced BISI. Okay, it doesn't mean that. You have to stick with a narrative. Are you bullish or bearish? And you have to hold. It's very hard to do this as a new trader in development if you're watching lower time frames, because you start seeing things like, oh, this looks like that thing I saw 10 times. Okay, and that's not enough of a sample set to build an underlying narrative or understanding of a narrative. So, but when we understand that we're underlyingly bearish dollar, that means our focus for institutional order flow on euro is it's reasonable to expect external range liquidity, which would be sell side liquidity, being purged, and then it runs higher. Create a sell side liquidity pool here. It drops down to it quick. Okay, see what it's doing here? Very quick to get that sell side. This low here, it's very quick to get down there. And once it gets there, does it dilly-dally around? Does it wait? Does it hem and haul? Does it waste a lot of time before it starts moving higher? No. That's your characteristic. That's a signature for IPTA. When it moves down to an area where sell side liquidity would be, and you're bullish, this is my turtle soup. Now, if you look at turtle soup that Linda Raschke and Larry Connors wrote in their book Street Smarts, again, a lot of people that are now just coming on board with me and just discovered me. I am not teaching the turtle soup pattern in that book. I'm telling you how I gained the confidence to go in and do what Larry Williams was unable to do in his own words, which was be like buying under. He most of the time, if you study him, most of his stuff was buying strength and selling weakness. And I tried to do that back in the 90s, and I lost just about 80% of the time. Now, I'm not saying he's at fault, but I just couldn't make that work for me. It just couldn't work for me. So I wanted to make sure my stops were smaller. And if you know you're low here, and you know your lows here, and you know your low here, once it dives down very quickly, and it's time of day sensitive, look, it's diving down into here. Okay, right in here. Late in the day, but still 1800 hours is an important time frame, as you'll learn in the core content. You'll get deeper into that, and 1800 hours is right there. Okay, and then we get a run up, which sets the stage for which is typically a New York close setup. It's late in the day, and it's resuming with what? The underlying trend of the bearish dollar, bullish foreign currency. So it runs quickly to get into the stops here below this low here at that run. So we want to see the ability to see price go higher without any difficulty, breaking up close candles, okay, because otherwise they would be bearish order blocks inside the swing highs. We want to see them just go right through them. Like we had this up close candle here. Price trades up into it, offers an imbalance, the rebalance, and then trades down again into old order flow. Hits it, consolidates, accumulates, and then runs to relative equal highs. And now we're sitting here. We want to see this thing continuously go higher. We don't want to see it drop down, because to do so, again, this is for your notes, to do so now after it's already had 1, 2, 3, 4 runs on sell side liquidity, it's actually showing you an underlying weakness. And while it still can go higher tomorrow at New York if it did that, it's far less likely to occur if we go below here now. Because the understanding I'm trying to force on you in this teaching here is to anticipate a run on stops and then get reaction immediately and go the other direction. And then every time it creates a low, you want to see those lows be supported. But if it runs below them, it needs to do so quickly and leave it and go the other direction. Okay, and that's institutional order flow. You want to see down close candles support price when it's bullish, up close candles resist price when it's bearish. But when you're bullish, you want to see those up close candles that would be bearish order blocks. You want to see them go through them easily. And if it's going through up close candles and old swing highs, you have really mapped out institutional order flow on a bullish side. So it's very easy to see that. You don't need trend lines. You don't need moving averages. You don't need that stuff. That's mine. That's Inner Circle Trader institutional order flow. Okay, it's not somebody else's stuff. It sounds like somebody else's stuff because institutional has now become a buzzword. But institutional order flow is exactly just that. Okay, are we running stops and running away quickly in the direction that we thought it was going to move? And if we're bullish, down close candles support price, up close candles are being broken. If we're bearish, up close candles resist price when we're bearish, and down close candles get traded through. It's offering no support. Very, very simple concept, but it takes a lot of time to study it. And that's why you want to go back and look at old price action over and over and over again. You can just do studies of that, 30 minutes a day. It doesn't matter what you're looking at, whether it's a stock or it's a commodity or a currency. You just want to be looking for that signature and draw that out on your chart and make annotations about it. And let that be a section in your journal, institutional order flow, and examples of it. And then see where the market actually breaks down. You'll see a market structure break. Then you'll see that whole paradigm shift Where if it was bullish, then now all of a sudden it becomes bearish, and then up close candles will keep price from going any higher because it's a bearish order block, and then down close candles will be traded through. Okay, and it's just an illumination that I can't articulate it in words. You just have to experience it yourself, and you only do that by practicing. All right, so that's the business on euro. We're still expecting higher prices there. Let's go back out to a daily chart and roll into cable. Video is a little bit longer than I wanted it to be already. All right, so here is cable. Cable's still hanging around inside its little tiny dealing range, and we'll talk about these levels here when we get down into an hourly chart, because I want to talk about how the suggestion I gave on Twitter yesterday in regards to giving your perception of an hourly or 4-hour chart the same way we would look at a daily chart. So in other words, when we're looking at a daily chart like this, and I say, okay, this is what I think it's going to try to do. It's going to do this, it's going to do that. And I personally think that we want to go above this high here. Again, expecting that bearish number to hit tomorrow in 8:30 New York time for the US dollar. Heavy jobless number. I didn't take a look at what the forecast is. I don't recall off the top of my head what it was, but I'm expecting it to be bigger than what they're looking for. And if it's bigger than that, that will be, again, another week of they forecast one number, then it comes out heavier. So that should not be bullish for the dollar. It should have a little bit of a weight on it, and that would give the pound reason to go higher. There's a clear buy side liquidity pool resting above this high here, SIBI here, and I've already outlined in the past here. I don't have it on the chart now because I want to focus on the lesson here, and I don't want to spend too much time talking about other things on the daily chart. But we've been stuck in this dealing range between this low and this high, and we're just a little bit above what would otherwise be considered the middle of it, or the equilibrium of that range. It just feels like it wants to go higher. Okay, and not that I'm going to cover Bitcoin, okay, but it just feels like we're going to see what Bitcoin did today. Okay, so look at your charts for April 29th of 2020, and you'll see you had a big range day on Bitcoin. That's what this looks like, because it's fractal. This feels and looks like something I've seen a lot of times, and we have reason to get up here. We have reasons to run buy side liquidity. I mentioned before how this higher high, a lot of people would have expected this, and then this start to run down here. Maybe it's top the market and go lower, and this would really upset that whole sentiment, and I like the idea of doing that. So we're looking for higher prices on cable. Okay, on the hourly chart for cable, we have all this business in here I mentioned before. I like the idea that they're going to get above this. I think they're still going to get a little bit higher than what they did here. All this did was run to the rejection block. Rejection block is right there. That's a close. Look at that price. In other words, look right here. Okay, the closing price on that candle was 125.17, and the high on here is 125.18. Okay, so we just went to the rejection block, and then we had that retracement lower. This line here and this line here, I'm going to show you in a moment when we talk about the lesson using the hourly chart. I'm not going to use the 4-hour chart, but the same thing I'm going to show you with the hourly chart in our lesson you would use for the 4-hour if it's applicable. And what that means, I'll tell you in a moment. But we look like it's going to trade above that 125.20 institutional. And if we draw out a little bit more, just have your mind set on that level there. It may not get there. Well, not that actually. Let's go right here. Here we are. So 126.47. So you know what's resting above that, right? What price level that we would look for? We would look for 126 mid figure, or 126.50. Okay, so that's the next upside draw if we can build momentum above here and we get that really hard breakdown on the dollar. Okay, so if dollar's going lower and it's really expanding on the downside, just finally giving up the ghost because this was really no reason for it to be going up, then this would allow real strong lift on cable. I still believe that this one's going to outperform on the upside, and this right here was just beautiful manipulation on their part. We have equal lows here, so I think that's right here, what we're looking for, we want to see it make an attempt to get through this high and this high, and it needs to do so with strength and momentum. All right, so let's go into a 15-minute time frame. All right, you see the 15-minute time frame. Just keeping it from going any lower. I mean, yeah, you can draw a trend line on all that. They might upset that overnight tonight. It would be nice to see them do that early on, maybe at midnight or just after midnight. Come down, run up on these sell side liquidity pool, and this small little fair value gap that would rebalance at a high of 24.42. Okay, so have that on your charts. If we drop down into that after midnight, that might be a catalyst to see it act just like we did here. You know, run below here and then go higher. That same thing could happen right in here, and then that could propel price higher if we do see that weaker dollar. So it's a lot of contingencies on this, which is like any other market day, but that's what we would be expecting to unfold. All right, so here is the business on how to use your daily chart perspective, okay, or the idea of using a daily chart when we're in tight little ranges. What can you do with an hourly or a 4-hour chart? Well, this is an hourly chart on cable, and this is the daily range, okay, that we're going to call our dealing range for April 28th, 2020. That's what's being framed here, and this is the delineation that starts the 29th. So what I'm looking at is this is the entire little segment of price action. In other words, forget all this even exists, okay, and we don't know what is occurring over here. Now, clearly you guys can see on Instagram, I kind of expected certain things that I'm actually going to teach you here. And that's the only reason why I shared that chart where I had my limit order sitting in, because I'm actually going to give you the lesson here, so that way it supports what you see on my Instagram. I'm not going to do this every week. I'm not going to do it every day. I'm only doing it here because that was the real reasons why I took the trades I did in cable today. All right, so we have the 28th here. All of this framework from this low to this high, all of that range, okay, is what I was looking at. I was only working with that as a range. Now, because the economic calendar has the unemployment number tomorrow, which is Thursday, I wasn't expecting a lot of lift on cable, particularly this day. I was looking for shorts because I wanted them to make an attempt to get down and run these equal lows. And it needs to do so ahead of the economic calendar day that would otherwise be the driver for the week. In other words, the big heavy hitter, even though today was FOMC, nobody's really caring about FOMC right now. They're worried about the employment state. Okay, and as I've already mentioned this before, the number that everybody's watching and the market's being sensitive to is employment, because everybody around the world is having difficulty getting back to work. So regardless of your opinion about COVID-19 and what it is and what it ain't, we're leaving it out of this discussion today. It has caused people to not be able to earn a living anymore. So now they're getting unemployment or living off of savings. So that's the reason why I didn't expect it to have an explosive move up, and I didn't expect it to have an explosive move down, because it's really just setting the stage for tomorrow, which is that unemployment number in the U.S. So we have sell-side liquidity resting below these equal lows here. So the dealing range low is the low here and the high here. All I'm doing is looking at the lowest low and the highest high, and you'll know what this means by applying IPTA data ranges. Okay, the only thing I'm doing is using a blanket concept of what I teach in that topic and teaching that I've not exhausted yet, but I'm applying it to a very small little fractal in price action, and I'm ignoring. Okay, whenever I give, well, let me finish that statement. I'm ignoring all of the data before this candle's formation, and I'm only focusing on the price action of the 28th. Okay, so this is what I'm looking at, and this is all I worked with today. Okay, so I get a lot of flack from people that are new or just real stiff-necked. They're just real snooty. They think that they know everything. Okay, and when I post something on the internet, on Twitter rather, and I'll say, "What do you see?" Okay, what I'm doing is, and many of you probably don't realize what I'm doing, but I'm teaching you by repetition just like working out your muscles when you go to the gym and you do exercise. I'm exercising your perception. I'm giving you the opportunity to see what you think you see. And over time, being with me and learning things, your eye's going to go to what you're trained to see over and over and over again. It's not important for you to be right every single time, but over time, you're going to see that you're more right than you are wrong. And that's exactly what trading is. Okay? But what I'm doing is I'm teaching you how to see those footprints in the snow, just like a tracker or hunter. This is all you need. You don't need bias. Okay? Because what I'm showing you today is how I worked within the range from the 28th on cable, and I did all the things that you saw on Instagram based on all that. So we have the range high and the range low, and we have an imbalance right here. I don't care about any of the price action after or to the left of this candle, and I at the time didn't know what this was going to be. So this was the hard right edge right here. Okay, that's what it looks like. Now, training with me, you know that we've created an imbalance here, really too clean there. Was there really any stop runs? The most recent is here, but we went to new highs here. Have they really run any new stops? They had a small one here, but it spent too much time and then went to new highs. So I like the idea of this low and this low here being in terms of relative lows, relative equal lows. So there's sell side liquidity resting below that. So if we highlight this, okay, all I'm teaching you to do is practice like this and do it in a lot of hindsight. Don't expect to be able to do obviously what you see me doing on Instagram, because that's just me showing off, and it might not be something you're interested in seeing, but please don't try to correct me and tell me not to do this or do that. I'm over there doing whatever I want to do in my free time, and none of you actually have the right to tell me what I should or shouldn't do in my free time. So without any disrespect, just keep that in mind, please. All right, so we have sell side liquidity resting in here in the dealing range low, and I guess I really should have had it up here. There's the dealing range low there. All right, and that's the high we're working with. So price rallied up into midnight time frame and rebalanced this SIBI. So what I wanted to do is I want to see, does it have the willingness to want to go lower after it's rebalanced? Because I don't believe, because the economic calendar tomorrow really is the catalyst for momentum and volatility. I think that we're going up here to rebalance, and that's a perfect opportunity to run lower to take the liquidity out here. Okay, so the market goes up slightly, runs these relative equal highs, and breaks down. When this candle closes, this is what we have. Okay? When that candle closes, immediately my eye is thinking, there's your bearish order block there, that last up close candle. And I got to draw this back out a little bit. Thin this out. All right, so there's your bearish order block, and it price trades right up into that, right up into it. Here's your open, 24.74, and here's your high, 24.74. So it bangs right into the bottom of that body, and there's your sell. What's it going to target? The sell side liquidity resting in here. That's your structure, that's your catalyst, that's your framework, that's your setup, that's your everything. Okay, looking for it to run lower in London, and then if it gets down below these equal lows, remember the context is this: tomorrow's economic calendar is the unemployment number. What did I tell you Sunday? We want to be watching that Thursday event, because that's where all the focus is right now, employment number. So everything else leading up to that is just going to be banging around inside of ranges. That's what this is. So when I attacked cable today, I wanted to see it trade down into here, and it got it. And then once it gets down here, I want to see it trade higher, and we got it. So I want to drop into a lower time frame 15-minute chart, and right away you can see a whole lot more context. Here's those equal highs on the 15-minute time frame. Okay, and what I showed you on the hourly chart, I'm treating that in the same way that I would do otherwise with a daily chart, dropping down into an hourly. So this chart is doing the work that would otherwise be seen for a hourly chart. Equal highs, we want to see it run up into there, and once it runs that, we want to see it reject. If it rejects, we have the confidence to get in there and start looking for rebalancing, institutional entry drills, and we have it right here. There's your high it needs to trade to, high at 24.72. This candle over here, that's where you could filled going short. If you don't want to use that one, you can use it returning back to the bearish order block right in here on the 15-minute time frame. Again, with the expectation that we're looking for it to trade below these equal lows and below the lows formed on that hourly chart, which is acting like the daily. And remember, all this movement here is occurring during the London setup, okay? And then we go into New York, and then I had a market reversal profile. So I shared the setup of my charts showing that I want to see it go up to a specific price level, then trade down to a specific price level and catch a buy and make an attempt to go up again to catch another 20 pips. The rationale behind that, okay, was what I'm showing you here. The fact that we went down below the lows, and the underlying bias is bearish dollar that's going to really should accelerate on Thursday, but this is the day before Thursday. So it's likely to come down, knock out anyone that's long getting their sell stops, and then it should be bullish. Okay. And with that said, we can see how price, created the run here. We dropped down to 24.10 and then rallied again. So the short, the long, the short, the long, it was multiple trades, but with the assumption that it was going to stay not far outside of the range that was created on the 28th. But notice what I'm doing here. Sticking to the bias, bearish dollar, bullish cable. So it makes sense to want to come back down here below these lows and below these lows, but not to go down and keep going lower. To go down to set up a opportunity for smart money to buy at a very deep discount. And then move into the logical idea of, okay, well, if we ran the stops, what should happen after that? We look for institutional order flow. Right in here, we have a SIBI. Change the color. Right here. So this candle's low at 24.09, and this candle's low here 24.09. You got to cut through candles because we don't do supply and demand around here. This imbalance, well, yes, it rebalances here, but it wants to many times come back to hit that again. That will create what? Sensitivity, much in the same way that an order block would. But you don't need to come all the way back down here. So how do you know, and this is for your notes, how do you know when the market's not going to go down to this candle here or when it should go down to there? Well, if you have the context of it running below these old lows over here and adding the fact that the economic calendar Thursday is where we were focusing for the biggest injection of volatility and weaker dollar, all of this fits a narrative that this is just a stop run. And then once it leaves there, okay, to come all the way back down to this last down close candle is not supportive, okay, or what would be reasonable in terms of seeing a stop run and quickly run away. But if you have a imbalance over here, extend that through and you'll see that this is where we're at. And that's why you'll see I'm taking profits on a short 5 pips ahead of the level that this is here. Remember, I'm 5 pips, 10 pips, sometimes 20 pips, depending upon the setup, ahead of the level because I want to make sure I get out. I have a very good likelihood of getting out if I get out earlier than I perfectly would. Okay. In other words, the ideal scenario calls for 50 and I'm bullish. I'm out at 40 and I don't care about that last 10 pips. And I don't care if it goes to 65 because I want consistency. I'm not in here trying to show how I'm perfect at every turn. I want to be consistent in my ability to harvest consistent pips. I want to get pips over and over and over again. And I don't want to be wasting time trying to drive myself crazy with the absolute exit that's perfect. Okay, I've grown content with enough, and that's what I teach. So you can see all of the framework that I outlined here. That's what constituted the framework for me to do what I did in cable today. My only regret is if I wish I would have held on to it longer and not getting out at 24.35 and right in here, because it came back down and created an opportunity to go higher. And I needed a nap. I was tired. The last 2 days I've done a lot of emails. I've done a lot of executions on cable and making an attempt to really show myself over on Instagram. But we're looking for it to go higher. We're looking for this high to be taken out, and because this is the current dealing range. So buy side liquidity, even though it rests here, the larger pool of liquidity is here. Okay, so our focus on cable, just so you know, going forward, I'm looking here. Okay, and that's where we're at for right now. But I do expect maybe a likelihood of this breaking down and upsetting this perfect little trend line that they got going on here. And if it hits that, it would clear up the sell side liquidity, relative equal lows, and this BISI would be rebalanced. And it could shoot through it a little bit and maybe hit this down close candle order block. And again, it would take away all of this trend line business that's going on here. Okay, because that's what they're reacting off of right now. And they may run this high here. Oh, good grief. They may run the high here with this and then drift it lower overnight. That's what I would do if I was making the market for cable. I would run this high, then sink it down, rebound to this price point here, and then going into tomorrow in New York, I'd be up above this high here and just totally blow everybody out of the water. That's what I would do personally. But last bit of business, I'm going to close the E-mini S&P. Okay, traded 2 hour volume imbalance. So I had you guys looking right here. Okay, and just about 95% there, but nonetheless, back here we're bullish. All of this is what's been had since then. I want you to study all of this price action from today's price action here all the way back to Friday. Okay, look at Friday's data all the way to Wednesday. Okay, today. And when we touch base on Friday, because I have plans on Saturday and Sunday with my family, so you're going to get your review on Friday evening. I'll have a lesson on this right here, and it's all this price action. But again, go back and listen to the commentary. We were not looking for it to go lower. We were looking for it to go right up in here, and it delivered right to it. And well, not quite. I'm still a little short of it. What's the close here? 29.64, and we still have. Get that thing out of the way here. We have 59.75, so about 4.5 points to go. So it's not bad by itself. Right here is good, but to get perfect, we want to see it trade back to the body of this candle's close. Okay, and if we trade above this and close, that's really bullish, and that might take us into them running the highs here, which would set up again, totally different scenarios that I'll cover if we get that development. I said I would be done after this, but I just remembered gold. Let's touch real quick on that. So here's gold. I like the idea that we came down, hit the order block. I mentioned, if I'm not mistaken, we want to see 1695. Could they go down to 92? And I think it was based on this order block here. Go back and listen to the previous recording on Sunday just to make sure I'm being honest here. I believe I am, but I like the idea. We hit that, rejected, and we want to see it. We want to see it rally, and it would be perfect with bearish dollar tomorrow, and we could see it run into that 1750 level and above. So next upside objective would be 1800 above 1750, and then we start probably really accelerating. If we can get it to 1800, I think it'll really start to spread quickly to reach that 2000, and it gets really interesting because by October or November this year, this thing could very easily, if everything stays the way it is, could see 3,000. Okay, so that's going to be it, folks. I will touch base with you by way of Twitter if there's anything interesting. Tomorrow, obviously, I'll be prodding you on Twitter around the 8:30 in the morning news event for unemployment numbers to hit the market. And I think that'll be it. Again, Friday evening, you'll have your review probably around 11 o'clock. Give me that much time, and then I'll talk to you then. Wish you good luck and good trading.